One of the reasons, one of the problems with Japan is the share of population that is above 65 is very high. They live long, and those guys have a lot of money. They're retirees. And there's a lot of money coming into the markets, and that means it's a glut in the money market. And those guys don't want to take risk. They just want income. If you look at Coke, they have a beta of 0.59. Again, whether or not that's a good number, we'll worry about that later. And let's look at NVIDIA. Something funny going on here. It is a beta of 173. So if I calculate this for Coke, expected return is going to be 4.2% times, not times, plus. Calculating both. For Coke, 7.74%. Now, if I'm valuing these companies, whatever your valuation model is, discounted cash flows, some sort of discounted earnings. There is something we use in accounting as well. It's called residual earnings model. You need to discount those future predicted stuff by a rate. You're going to use a much lower rates for Coke compared to NVIDIA. Okay, why it's riskier? And these are also important, not just for stock valuation purposes. And this is kind of going to be next item in our agenda, the capital budgeting models. You guys remember things like net present value? We use a discount rate in those, right? Those discount rates come from numbers like these. So for a project to be acceptable for NVIDIA, it needs to be producing roughly twice expected cash flow compared to Coke. Coke can get away with relatively low cash flow projects because they're not as risky, but NVIDIA cannot. They have to have really big stuff. Okay? That's where the main use of CAPM or models like CAPM is in capital budgeting to figure out the cost of equity capital. We'll also look at the cost of debt and stuff and get the so-called weighted average cost of capital. But that part is easy. Once you have a reliable estimate of cost of equity, then you can go from there. Now, let me kind of give you a sneak preview of what we're going to do on Thursday. This also says if you looked at historical data over long periods of time, you kind of sorted stocks based on how much money on average they made. Okay. Those average returns should highly correlate with their betas. Okay. It says the only reason you would expect a stock or a portfolio to have high return is because they have high systematic risk exposure. So it is not too surprising that NVIDIA would have higher returns relative to the market. I mean, I don't know what market did year to date. I think it's about 5%. So if NVIDIA did 10% or relative to Coke, let's say Coke did 5%. If NVIDIA returned 15%, that would be just normal, okay? According to CAPM model. That is not something to write home about. The only reason you had 15 instead of 5, you took roughly 3 times as much more risk. That's your compensation for taking that risk. Obviously, it's a lot more than that, which means some other stuff are going on. But if you did look at historically, uh, historical evidence suggests, and I'll actually get you the PDF of the papers that actually looked at this systematically, and pun is not intended. Fama and French. Fama is short for Eugene Fama, who actually got a Nobel Prize in economics, for partly because of this work. The other is one of his former students, Cam French, in 1991. Higher beta uh, necessarily implies higher returns, but CAPM also says the relationship should be linear. So if you got two portfolios, one has twice the beta compared to the other, its expected reward, which is expected return minus risk-free rate, should be twice as large. That is not necessarily the case. Okay? For example, if you sorted stocks based on size, smallest 10% of stocks historically yields about 6-7% more than largest 10% of stocks. Let's say there are 10,000 stocks, you sort them based on their market cap. The smallest 1,000 is the small cap portfolio. The largest 1,000 is the large cap portfolio. Now, as long as their betas actually have similar relationship, but betas of small cap stocks are not as large as the as large as the betas would be implied by the so-called size premium. That's kind of short term. uh, shorthand for the excess return of small cap stocks over the large cap stocks. So this suggests that there is something else is going on. Another one, if you sorted stocks based on book to market ratio, here um, high means you're a value stock, low means you're a growth stock. Historically, value stocks outperform growth stocks by about 2 to 4%. Again, you cannot justify that with the differentials in their beta. What Fama and friends came up with an explanation. They said, yes, you're talking about a systematic risk, but there are more than one way of looking at systematic risk. One is the overall market risk. Okay, overall market goes up and down. Obviously, it affects everybody. That's fine. But there is also systematic risk that influences the large amount of stocks, but that kind of specific type of stocks. Think about small stocks. When the economy goes into a deep recession, who's going to be the victim of credit crunch? Large firms or small firms? It's a rhetorical question. Obviously, small cap firms, because banks are not going to be as willing to lend to smaller firms as they would be to larger firms. So that means small stocks have kind of a built-in financial distress risk over and above what goes on with the market. Similarly, value stocks, these are low P kind of stocks. They are value stocks because they have some financial issues. They also have financial fragility issues. So they kind of said we can have multi-factor asset pricing models. Remember, in CAPM, the return on the market portfolio is kind of mimicking the systematic risk. In the multi-factor asset pricing models, you have, come on, multiple factors behind systematic risk. And to make it operational, they came up with so-called empirical asset pricing models. Their so-called famous three-factor model. In addition to market risk, they also put in the difference between the returns of small caps and large caps, and the difference between the returns of value and growth stocks. Then you can use linear regression to kind of estimate their factor betas. Then you go from there, which we're going to start doing on Thursday. All right. So I'll stop here. I'll see you guys on Thursday. Hopefully my keyboard is going to be charged by then. Even my mouse is saying charge me.